Good afternoon, everyone, and a warm welcome to this ICAS Autumn Tax Webinar General Tax Update. My name is Katie Close and I will be hosting the webinar today. For those of you who don't know me, I have very recently joined ICAS as the Director of Tax. Our event this afternoon will last approximately 1 hour, covering information on the autumn budget and some other recent tax changes. Susan Cattell, our Head of Tax Technical Policy, will be taking you through the technical detail in just a few minutes. But before we begin, just a few housekeeping matters to remind you of. Due to the volume of material that Susan has to cover, there won't be time for a live Q&A today, but there are other ways to get in touch with us and ask your questions. Either through the chat box, which can be accessed at the top of your screen. This allows you to comment or discuss with the fellow attendees on anything covered today by this webinar. Alternatively, please feel free to send any questions to our email address, tax@icas.com. We are recording this webinar and will send it out by email within 48 hours. The session slides will also be available on the website, but for ICAS members only. We will also have 5 short poll questions coming up on your screen shortly so that we can see your thoughts and reactions to the budget. The answers are completely anonymous, but we may use the results on various ICAS platforms. And I think you should be able to see the first of them now, so please answer these if you can. The information is extremely valuable to us. Before we get into the technical detail with Susan, I also just wanted to say a few quick words on the budget. I think many of us will have felt that it was fairly anticlimactic. There was months of speculation in the lead up to the budget, and in the end, many of those most anticipated measures never arrived. So what sort of budget was this? It was one of the largest tax-raising budgets in the past 50 years. It's a budget that is largely built on the basis of future tax revenues, with many of the largest tax-raising measures not due to come into force until 2028 or later. And it's a budget that has also tried to find those tax revenues through many small changes, rather than going for more structured reform. I believe there were 209 tax changes in total. So fundamentally, it's also a budget which introduces further complexity into the UK's tax system and does not promote transparency, 2 principles which ICAS consider essential for a well-functioning tax system. So this added complexity, of course, is going to add to the strain on HMRC resources. I'm sure if you contact HMRC, you will experience the customer service levels, which do seem to be consistently rated poor from speaking to those who do contact them as an agent or a business owner. So the risk with adding many small measures and of relying on these future tax revenues is that it adds uncertainty into the system. Today's spending and borrowing decisions are relying on tax revenues that will arise in potentially up to 3 years' time. While this, of course, gives welcome relief to those who will be affected by the changes, it also gives ample time for them to change their behaviour and plans. If we look at the changes to salary sacrifice or pension contributions, for example, this is expected to raise £4.7 billion, but it's not introduced until 2029. So the question is, will it actually achieve that? We now get to see how businesses and individuals will react to that change, and of course, it could change how much revenue that raises. I also think it is clear that many of the tax measures were introduced to satisfy political aims. For example, the income tax threshold freeze, an obvious compromise on the income tax rate increases that we all thought were coming. In the end, though, the impact of those frozen thresholds equates to raising the tax rate by at least 1%, and some forecasts indicate it could be as much as 3.5% by the time we get to 2030/31. So what does this really achieve? It's the same outcome as directly raising tax, but in a far less transparent manner. Are tax policy decisions being hindered by political considerations? I think that's beyond the scope of today's webinar. But in terms of how we scrutinise the budget and the tax policy decisions made by the government, I feel that education is a key accountability tool. I think there's still much to be done there, especially in terms of how UK budget decisions affect Scotland. If the public, finance professionals, and in certain cases, our politicians don't understand, forecast the budget decisions and the consequences for the economy and public finances, then there is no real accountability there. My final thought on this is that a long-term strategy and forecast is really needed for the UK as a whole, but especially for Scotland. If we consider again the changes to salary sacrifice for pensions, how does that fit in with a long-term outlook? Arguably, it could be said to disincentivise saving for pensions at a time when we know we have an ageing population who will likely not have enough saved for their retirement, and we have a widening gap between public sector and private sector pension savings. So does this choice really align with the long-term fiscal and economic needs of our society? Ireland has just published their Future 40, a long-term fiscal and economic outlook. A similar project here could be very valuable to help guide us for the future. So now we turn to the technical detail, and I am delighted to be joined this afternoon by our speaker, Susan Cattell. Susan is our Head of Tax Technical Policy and works closely with the ICAS Tax Board on the direction of ICAS tax policy. She also represents ICAS on various HMRC committees and has a wealth of experience from working at HMRC and in practice prior to joining ICAS. So on to Susan.
Right, good afternoon, everybody. Welcome to this afternoon's autumn tax update. It's a bit late, really, for autumn, but I think we have to blame the Chancellor for that, having such a late budget date. So if I can just move us on to the first slide. Oh, several more slides. Right, today's agenda. What are we going to talk about today? Well, normally, as those of you who've been on these sessions before will know, I like to do the budget or the latest fiscal event and a few other things too. Unfortunately, this was an absolutely huge budget. As Katie said, somebody at an HMRC meeting this morning said that they'd counted 209 tax measures, and I assume they should know. We cannot possibly cover 209 measures in an hour. In fact, when I put this slide presentation together, I was then forced to drop a few things I really, really wanted to talk about because there simply isn't time. So do remember to go and have a look at UCLA. That's the overview of tax legislation and rates. You know, just run an eye over it because there may be things you are interested in that I haven't had time to pick up today. The finance bill and explanatory notes was also published on the 4th of December, so that's available. I have put some clause numbers on the slides. Obviously, bear in mind that as it works through the parliamentary process, those clause numbers may well change, but it's a useful starting point. I am going to cover the main taxes. Really, an awful lot of it is going to be the budget, particularly on personal tax. I've got one or two other things to say. One or two other things on tax administration and raising standards in the tax advice market. The thing I will not be talking about today is devolved taxes, because there's going to be a separate webinar after the Scottish budget, which Katie is going to run. So do keep an eye out for that and sign up to attend that, which will probably be sometime in January. So without further ado, let's get on to the budget. Now, Katie's already given us a few overall thoughts on the budget. I just want to focus in on the manifesto pledge that the Labour government put in place before it came into power, not to increase national insurance, the basic, higher or additional rates of income tax or VAT, and corporation tax is going to be capped at 25%. That's obviously the main rate.
Apologies, you haven't taken control of the slide, so you need to do that first before you can move on. Thank you.
Oh, sorry, Flo. Right, apologies, they were moving, so I assumed I had. Right, 2025 budget. The manifesto pledge was not to increase those things. Now, those are the four main revenue raising taxes. So if you say that you're not going to increase those things, then you have got a bit of a problem. You've put yourself in a straitjacket if you want to raise significant amounts of money. And we all know that, of course, the Chancellor did want to raise significant amounts of money to give herself more headroom, as she put it. And also she has committed to only holding one fiscal event per year. So I'm assuming she certainly doesn't want to come back in the spring to raise some more money. Now, that one fiscal event pledge is quite interesting because I had a look at what we've had since the government came in after the election, and we've actually only had two budgets. That's absolutely true. We had the one last year at the end of October and the one this year, but as you can see, we've also had a spring statement. We had the tax update, simplification, admin and reform day in April. We had the L Day draft legislation, and then here's a treat for you at the beginning of next year, we're going to have another one of those two-czar days. So there have been rather a lot of tax announcements and tax consultations and so on. So it may only be one fiscal event a year, but there's certainly not been any shortage of tax announcements and consultations. So let's just move on to personal tax. Now, this was where an awful lot of the changes were, and that's not really a big surprise, because I said those were the four main revenue raising taxes, but income tax and national insurance are actually top of the list. So again, if you want to raise some money, you absolutely, if you're the Chancellor, you really are going to have to make personal tax changes. But what she's chosen to do, instead of what you might call a nice simple measure of just increasing income tax, what she's actually decided to do is lots of smaller measures. So instead of raising a significant amount of money by increasing the rates of income tax, particularly the basic rate, 1% on the basic rate of income tax would raise about 6.9 billion in the first year. But she's chosen not to do that. So she's got to do lots of smaller things that actually raise a few billion here, or half a billion here, half a billion there, and so on. Now, the first thing she's done, which does actually raise a significant amount of money, is that she has decided to extend the freeze on income tax rates and allowances. So the income tax personal allowance is frozen. I'm sorry, there's so many messages popping up in the chat that I keep right. Okay. The income tax personal allowance is frozen at 12,570. The basic rate limit is frozen at its current level. The higher rate threshold is frozen. All of them are going to be frozen now until 5th of April 2020-31, as is the additional rate threshold. Now, you'll see I have noted there that was actually reduced in April 2023 to bring more people into the additional rate, but it's not been changed since then. And it's frozen for now. Now, what she has managed to do, of course, is not to change the main income tax rates. They're unchanged at 20%, 40% and 45%. But the other thing she has frozen is the primary threshold for Class 1 NICs, because that's aligned with the personal allowance, and the Class 1 NICs upper earnings limit, because that's aligned with the higher rate threshold. So essentially, we have just, those of you who've been to my spring and autumn updates before will have seen this slide before, but as you can see, I've had to update it because she has extended the freeze. Now, those of you who were here in May when we did the spring update will know that last October, Rachel Reeves said that she would actually unfreeze these personal tax thresholds from April 2028. Now, clearly she's changed her mind on that, or she's been forced to change her mind, and they are now frozen for even longer. So what's the impact of that? Because you may remember there was a lot of discussion with the Labour government saying, well, we're not going to do tax increases for working people, which was another part of that manifesto pledge. So how true is that now? Well, if we look at what the Office for Budget Responsibility has said, they predicted the yield from these freezers at the basic, higher and additional rates is forecast to yield 56 billion in 2030-31, of which 12 billion is from the freezers announced at this budget. So just this budget, and of course there was more money to be raised from the freezers that the freeze she put in last year. I'm sorry that I'm just, every time that somebody puts something in the chat, it is popping up and I'm losing my thread. Right, so the yield from the freezers is significant. And the impact on actual individuals is that between 2022-23 and 2030-31, so that's the extent of the freeze, 5.2 million more individuals are going to have been brought into paying income tax. Now, some of those will be working people. Some of them may well be pensioners, because the state pension has been going up in line with this triple lock. And some pensioners as well may have been brought into paying tax because interest rates are high. So if they've got a bit of interest income, that may help to bring them into paying tax. 4.8 million more people are going to move into higher rates, and another 600,000 people are going to move to the additional rates. And the proportion of taxpayers paying tax at the higher or additional rates is going to move up from 15% in 2021-22 to 24% in 2030-31. So where does that leave us on no tax increases for working people? Well, I quite like the Institute for Fiscal Studies. They did some analysis of this, and they went right back to 91, 92. So let's not say, I mean, this is clearly not just something that started with the current Labour government, this trend. But in 1991, 92, 3.5% of UK adults were paying tax at the higher rate. By 22, 23, it was 11% paying at what were by then the higher rates, and that's set to reach 14% by 27 to 28. Now, notice that the IFS is talking about adults, not proportion of taxpayers. But what the IFS concluded was that by 2027-28, 1 in 5 taxpayers or 1 in 7 adults will be paying tax at the higher rates. And more tellingly, they had a look at some actual professions. So they found that in the 1990s, essentially no nurses and just 1 in 16 teachers paid higher rate tax. By 2027-28, more than 1 in 8 nurses and 1 in 4 teachers are set to be higher rate taxpayers. So that's a really big shift. And I saw something from the Police Federation as well that suggested that at the moment, about 19% of full-time officers pay higher rate tax, but that's expected to rise to 97.8% by 2030 to 31. Now, I'm kind of assuming that the government would accept that nurses and teachers and police officers are working people, and that all these stats do rather tend to suggest that there are some fairly significant tax increases, either that have already happened but are on the way. So let us move on. Now, we did say that Rachel Reeves had obviously stuck to the pledge, if you like, not to increase the main rates of income tax, but that hasn't stopped her increasing other bits of income tax. So the first up, we're going to talk about dividends, because the income tax rates on dividends it's been frozen for the last few years, from 2022-23 to 2025-6. And I've got the rates up on the slide. I'm not going to read them out to you. But what she's decided to do is from April 2026, she is going to increase the tax rate on dividends. So she's added 2% to the ordinary rate on dividends and 2% to the upper rate. Now, for some reason, she decided not to increase the additional rate, so that's remaining the same, but the other 2 dividend rates have increased. We think that she may have decided not to increase the additional rate for dividends, something to do possibly with international competitiveness, at least that's been some speculation anyway. And the tax-free allowance for dividend income remains £500 for 2026-27. I mean, I think it has to be said that there probably wasn't much scope for her to reduce that any further. And those of you who've been in tax for a few years will no doubt remember that when that dividend allowance was first introduced in 2016, it was £5,000. Then it was cut to £2,000 in 2023 and down to £500 in 2024. So I suppose you could say the only place left for a chancellor to go was to increase the rates, because there's not really more scope to cut the allowance. And the OBR estimates a yield of 1.2 billion a year on average from 27-28. They've taken account there of the fact that some people will probably pay them. If you own a company, for example, and you pay yourself dividends, you could decide not to pay any, in the hope that maybe further down the line, a different government will change the policy and you could extract the money then. Right, savings income. Now, one thing that the government has said is that they want to narrow the gap between tax paid on work and tax paid on assets. So, of course, that would be behind increasing the dividend rates. And similarly, I think it's behind increasing the tax on savings income, because for now, up to 2026-7, the rates of income tax on savings income are unchanged. And for people who are eligible for the starting rate for savings, the limit remains 5,000 up to and including 2030-2031. But when we get to April 2027, so that's the 27-28 tax year, the savings rates are all going to increase. So whereas before they would have been the same as the main rate of income tax, so 20, 40, 45, they're going up to 22, 42, 47. And note that this time it's all 3 of them that have been increased. Also on savings, The ISA subscription limit remains 20,000 for 2026-27. There was speculation that it might be cut, but from 6th of April 2027, the cash ISA limit reduces to £12,000, except for savers over the age of 65. And I think this is quite important because obviously this is the Chancellor wanting people to invest in companies. She probably wants them to invest in British companies, but as this government dropped the plans of the previous government to have the Great British ISA, obviously all she can do is try and encourage people to go into stocks and shares generally. So unless you're 65 or over, from the 6th of April 2027, you'll only be able to put 12,000 into a cash ISA. And if you want to do more, you'll have to have a stocks and shares ISA. So let's have a look. The OBR estimate that this is going to raise 0.5 billion a year on average from 28-29, including a small behavioural response of people deciding to put more of their money into ISAs, which I feel sure indeed that they will do. Now, property income. And again, I think this is fitting with this trend of trying not to tax work and to tax assets instead. Now, some of you will no doubt be aware that at the moment there aren't separate property income tax rates. They're not legislated for, whereas there are already separate rates for savings. It's just that they haven't actually been used. They've been the same as the main income tax rates. But Rachel Reeves is going to create separate tax rates for property income. And again, this is coming in from 27-28, from April 27. The property basic rate is going to be 22%. The property hire rate is going to be 42%. And the property additional rate is 47%. And I said I wasn't going to talk about devolved taxes, but I will just mention this, which is that the government is going to engage with Scotland and Wales to provide them with the ability to set their own property income rates if they want to, in line with their current income tax powers, and that will take effect from 6th of April 2027. So it remains to be seen whether the Welsh and Scottish governments want to do that. The OBR estimates that this will yield 0.5 billion a year on average from 28-29. So as you can see, lots of changes, adding complexity to the tax system, but only raising a bit of money for each change, other than the freeze on thresholds, which I think does raise quite a significant amount of money. But it's all dwarfed by what she could have raised if she'd sort of increased the main, some of the main income tax rates. Right, now this is a bit sneaky, so I really wanted to mention this because I think it might be quite easy to overlook this. There's going to be legislation in the Finance Bill 25-26, it's in Schedule 1, to change the way you do the income tax calculation. So before I put the rest of the slide up, just to give you an example, at the moment, when you're calculating your income tax, when you get to the second stage of the calculation as set out in Income Tax 2007 in those sections, you have to deduct your personal allowance somewhere. Now, clearly, when we get to the position where there's a higher tax rate on property income, let's say you as an individual have a salary, employment income, and then you have some property income, what you would want to do is to set your personal allowance against the property income first to minimise your tax. And at the moment, that is what the calculation rules say. You set off the personal allowance and certain other allowances and reliefs in the way that will minimise your tax liability. Now, that is going to change because what's going to happen is that those reliefs and allowances and the personal tax allowance is the main one, or the most common one, shall we say. Those reliefs and allowances will have to be applied first against any income that is non-savings, dividend or property income. So in the example I just gave you, what you will have to do is set your personal allowance against your employment income, not your property income. Now, if you use it all up against you, and there's some left over, you could set that against property income, but it's first of all got to go against non-savings, dividend or property income. So that's quite a sneaky little change, and definitely one to watch out for. Now, there's a really good technical note on all these changes to property and savings, and it includes this ordering of reliefs and allowances. So if you go and dig out the technical note, there's a really nice example at the end of it, so worth having a look at. Right. National insurance, salary sacrifice and pension contributions. There's been a huge amount of press coverage about this. So I think it's quite important to just put some of this into a bit of context, because from April 2029, only the first £2,000 of employee pension contributions through salary sacrifice each year will be exempt from NICs. But the first thing to note here is that this is only really relevant to anybody who's got a salary sacrifice scheme for pensions. And as we shall see in a moment, that's not everybody by any means. And secondly, it's really important to note as well that they're not taking away the income tax relief. So contributions through salary sacrifice, like other pension contributions, will still be eligible for income tax relief, subject to the usual limits. Now, salary sacrifice contributions above 2,000 will be subject to employer and employee NICs, like other employee pension workplace contributions. And clearly what the government would like is that employers, they say quite confidently, employers will report the total amount sacrificed to HMRC. So that will be the amount up to 2,000 and the amount, the excess, so that of course then HMRC can, charge the class the NICs for the employees and the employer. There is going to be detailed HMRC guidance on that, apparently. Now, of course, some employers may simply revamp they may decide not to do salary sacrifice, for example. We shall have to wait and see, but that's certainly what the government's hoping. It's predicted to raise 4.7 billion for the government in 2029-30, as Katie mentioned earlier. And the Treasury is very clear. It says most employees making typical pension contributions and their employers will be unaffected. And they also say that the costs of relief through salary sacrifice relate disproportionately to pension contributions from those on higher incomes. Now, I'm not entirely sure that that's the message you would get if you'd been looking at the press coverage. So just to put some context into this, there was a survey that's been widely publicised on the web by some employment consultancy, which suggests that 48% of employers, and it's mostly larger employers, far higher percentage of those with 250 or more staff than those smaller employers, operate these arrangements. So it's below 50% of employers operate salary sacrifice. And the HMRC published an impact note which estimates that 7.7 million employees currently use salary sacrifice, and of those 3.3 million sacrifice more than £2,000. So 44% of those who are actually using salary sacrifice schemes will actually be affected by this change, whereas 56% will be covered by that 2,000 threshold. And of course, it's irrelevant to all the employers and employees who don't use salary sacrifice anyway. And this is a really interesting thing, which Katie also touched upon. The ONS in 2019 noted that you're far more likely to be in a salary sacrifice scheme if you're in the private sector than you are if you're in the public sector, because the public sector has this kind of different types of pension schemes by and large, and they're very generous. So as Katie indicated, this does widen the gap between the public and private sectors. So I think it's certainly true that it probably does affect much more employees paying on higher salaries. Well, it obviously does. So let's have a look. What might employers and employees do? Well, obviously they've got plenty of time to consider this, because this is not coming in for several years. So they have time to plan. They've got time to review the costs to the employer and review the arrangements and what the options are. And I've certainly already seen things online offering to advise employers. And from the employee's perspective, assuming that their employer is perhaps going to carry on with salary sacrifice, then they will have to consider whether they're willing to pay that NIC. But I think one thing that shouldn't be lost sight of is that these are still tax favoured, because you still get the income tax relief. So it's not as though all the tax benefits of making pension contributions being taken away, whether they're salary sacrifice or by other means. So I think all of those things need to be taken into account. And of course, it will be unfortunate if it deters people from putting money into their pension pots, because we saw the research earlier this year showing that people are not saving enough for retirement. But say some of the press coverage does seem to have perhaps overhyped this a bit, and we do need to wait and see what employers decide to do. Right, capital gains tax. Now, I rather think that the Chancellor sort of did an awful lot on capital gains tax in the last budget and hasn't really done that much this time. There are one or two measures in UCLA, if you have a look, but they're not things I'm actually going to cover. So just to look at the sort of headline basic stuff, the annual exempt amount is simply not changing. And again, I've put in these past figures so you can see what's been happening in recent years, because 22-23 it was 12,300, then it was reduced to 6,000. I'm just talking about individuals here. 24-25 and subsequent years, it's been permanently fixed until a Chancellor decides otherwise at 3,000. So that's where we are now, and that has not changed. As far as these subsequent tax years go, it's still 3,000. Now, CGT rates, now, as I say, there were an awful lot of changes in the last budget, including a rate change in the middle of the well, not in the middle, but from the budget day in the 24-25 tax year. Now, because they've been legislated in Finance Act 25, we covered these in huge detail in the Spring Tax Update in May 2025. Now, that is still available on the ICAS website. So I've decided not to go through them all again because it's 6 or 7 slides and we really don't have time, and I want to cover the stuff that's new. So if you weren't here on the 1st of May, do go and have a look at the recording, which I say is available on demand. One thing I did just want to mention is that if you're still doing 24-25 tax returns, I'm sure some of you will be, note that HMRC now has a calculator for disposals on or after 30th of October 24 when the rates changed. So do go and have a look at that. It's quite helpful. So moving on, inheritance tax, the really deep freeze, because I was talking about the freeze on personal tax rates, but they've only been frozen for a few years. But the IHT nil rate band hasn't increased since 2009-10. So that's a really long freeze. And the residential nil rate band, which was introduced in 2018, reached 175,000 in 2020 to 21, and that's been frozen ever since. It's never changed. The previous government had sort of announced a further freeze to 27-28, and the current government last year froze it till 2030. And in this budget, they fixed it all for another year until 5th of April 2031. And I don't think anybody should be counting on them increasing it then, because it's rather like freezing the income tax thresholds. I think they feel it's a sort of more subtle way of increasing tax, and that people are less likely to notice it. I have a feeling that increasingly people may well be noticing it, particularly the income tax freezers, but there you go. Okay, let's move on to APR and BPR, agricultural property and business property, because there were some significant changes announced in the 2024 budget. So I'm just going to do a very quick recap of what the position is, because again, we covered this in detail in May, and then I'm going to tell you about the things that are new. So basically, we've got a cap on 100% relief for agricultural property and business property relief from 6th of April 2026. But there are some transitional rules, so depending on things like date of gift, date of death. So it's really important, obviously, to go and look at the details. Now, just a recap of the key points. The 100% rate of relief for your agricultural property, so your farm or your business, for the first 1 million of combined agricultural and business property continues. So you get 100% for the first million. But if your value goes above 1 million, then the rate of relief reduces to 50%. So if you've got a family farm and it's above 1 million, then you'll get, the million will still be 100% relief, but above that, you're going to have to pay tax on 50% of that value. Now, the rate will also be 50% in all circumstances for shares admitted to trading on recognised stock exchanges but designated as not listed, and shares listed on foreign exchanges which are not recognised stock exchanges. Which is a bit of a mouthful. But the first bit of that is primarily aimed at AIM shares, because there were quite a few inheritance tax planning vehicles that used AIM shares. So basically, they're all only going to get 50% relief going forward. And there's no 1 million allowance there at all. It's everything. There was a technical consultation this year about how all this would apply to trusts, because trusts are complicated enough anyway. And this is, of course, adding whole new layers of complexity. So now what's new? Well, the first thing that's new is a bit of an unwelcome one. What the government said in July was that they were going to freeze that 1 million allowance up to the tax year 29-30, but then after that it would be allowed to increase in line with CPI inflation. But what they've now said is, oh dear, we're going to freeze it for another year. And the legislation, which is in the finance bill, says that it will now increase in line with CPI from 6th of April 2031, although again, perhaps not worth counting on that, because either the same chancellor or another chancellor may decide to extend that freeze further. Now, the second point is really good news. Everybody, all the professional bodies have been calling for this ever since these proposals first appeared, because I'm sure you will know that any unused amount of your of the IHT nil rate band, or indeed the RNRB, you can pass it on to your surviving spouse or civil partner. Now, that wasn't going to be the case for the 1 million allowance for APR BPR, but they've changed that. So basically, you will be able to transfer any unused amount to a surviving spouse if the first death was before 6th of April 2026. And this was, of course, a huge problem for some families. Heard a lot about it from farmers in particular, because obviously if it was a husband and wife farm and one of them's died before 6th of April 2026, this was a huge issue. So the government has finally moved to address it. So that's the good news. Basically, there's going to be a £1 million allowance for the combined value of this relievable property in trusts, and there are also changes to the exit charges, but I'm really not going to talk about that because we simply don't have time. So I think if you're dealing with trusts, you will need to go and have a look at that. And we knew that they were going to give you the option to pay inheritance tax by equal annual instalments over 10 years, interest-free, where it related to agricultural property relief or business property relief, and that's now been confirmed. So the last thing I wanted to look at on inheritance tax is the unused pension funds. Because there have been some significant changes here since this was first announced in the last budget, the October 24 budget. So basically, there's no change to the fundamental point, which is most unused pension funds and death benefits are going to be in your estate for IHT purposes from 6th of April 2027. However, there's been a technical consultation. The original proposals were that the pension scheme administrators would have to administer all this. And essentially, pretty much everybody said that was unworkable. So one of the really key changes is that it's now going to be the personal representatives, not the PSAs, who are going to be liable for reporting and paying any inheritance tax due. Now, the problem with that is that everybody then said, well, nobody in their right minds will want to be a personal rep, because they could find that the pension scheme's paid out all the money to beneficiaries, and they, the personal rep, will be trying to chase after beneficiaries to get some of the money back. So the key change now is that the personal representatives can actually, in effect, give a notice to the pension scheme administrators to say that they must withhold 50% of the taxable benefits for up to 15 months, and that they must pay the inheritance tax due to HMRC before releasing those funds to pension beneficiaries. Now, if that period of 15 months comes to an end, or the personal representatives withdraw the instruction, then they can all be paid out. Now, this doesn't apply to exempt benefits. So, of course, if a pension pot's going to a spouse, that will be exempt. So it doesn't apply to that, because obviously there wouldn't be any IHT due. It doesn't apply to funds under 1,000, and it doesn't apply to continuing annuities. And this is a really important one. Once the personal representatives have done everything and all the tax has been paid, they can go to HMRC and get, in effect, a clearance from HMRC to say, that's it, you've sorted out all the pension funds. Now, if, say, 30 months later, another pension fund comes out of the woodwork that the personal representatives had no idea existed, as you can see from the slide, they will not be liable for that. You know, if they've had the clearance from HMRC, and they will need to make sure they get that, they will not be liable. So that's a real headline outline of this, and clearly, you know, it's going to be really complicated, but unfortunately time presses and we must move on to business taxes. Now, I have already said that the government had committed not to increasing CT rates above 25%, and the main rate does indeed remain at 25%. They also haven't changed the small profits rate or marginal relief. So capital allowances, the annual investment allowance remains 1 million. That was another commitment that they wouldn't reduce that. Those of you who came in May will remember that there were some first-year allowances for qualifying expenditure on zero-emission cars and electric vehicle charging, and they were extended to March or April 2026 by the last budget, and this budget is extending them another year to March or April 27, depending on whether you're unincorporated or a corporate business. Right, full expensing. Full expensing, obviously, very good news. It was originally introduced for 3 years, and then made permanent in 2023. And that continues unchanged. Now, of course, this is good news because you get 100% relief on main pool plants and machinery. So it's good news if you're eligible for it. But eligibility was quite restricted. It doesn't apply to the unincorporated businesses, and it doesn't apply to the leasing sector. And there's been a sort of little Treasury working group, which we've belonged to, which has been talking about whether it would be possible to extend it to the leasing sector, which, as you'll see from the slide, both the previous government and this government wanted to do when fiscal conditions allow. But that's not going ahead. And there was a meeting of the working group the other day, and we were told that basically money's too tight, they can't afford to do it. But they've done something else instead, because you may have noticed that they have reduced the rate of writing down allowance for the main pool. So all those companies, businesses out there who were thinking, oh, I've got this plant machinery in my main pool and I've planned on the basis that I'm going to get 18% writing down allowance. Well, unfortunately, from 1st of April 26 or 6th of April 26, the rate is dropping to 14%. And if your accounting period or chargeable period straddles that date, you'll get a hybrid rate depending on the days before and after the change. And the reason they're doing this, apparently, is to raise some money to fund this, a new permanent first-year allowance of 40%. And the key thing here is it's still main rate assets, expenditure incurred on or after 1st of January 26, but it's available for assets bought for leasing, apart from overseas leasing, which is specifically excluded. And it's available to unincorporated businesses, which full expensing wasn't, although, of course, many unincorporated businesses may well be covered by the annual investment allowance, but it is available to them. It's new assets only, not second-hand, so that's similar to full expensing, and it's not cars. So I think you could say that this is good news for the leasing sector. And I should note as well that HMRC will be watching very closely to make sure that this isn't abused. Unfortunately, there's something of a history in the leasing sector of a certain amount of abuse of capital allowances. And so HMRC are certainly going to be watching that very closely. So it's good news for the leasing sector and potentially some unincorporated businesses. It's less good news if you already had plant machinery in the pool and you thought you were getting 18% and now you're not, or from next March or April you're not. Making tax digital for income tax. I'm not going to go through all the details of MTD. We've done webinars on it before, and there are lots of HMRC webinars available. What I do want to do is to flag some resources that are available to you, because the first mandatory stage of MTD rollout starts in April 2026. So really important if you're making your preparations, if your clients are making preparations. We have the ICAS Making Tax Digital Hub now on the website, links to all the HMRC guidance and tools. And as I say, HMRC have some recordings of webinars that you can listen to. We also post articles that appear at the bottom of that hub page with all the latest updates, and the most recent one covered the autumn budget update. So I'm not going to tell you what they were. Suffice to say there was a few more exemptions and some more deferment, but you go and find the article to find the details. Now, the other thing is that the article before the autumn budget one actually highlighted some other things. One of them was the HMRC outreach programme. If you're an agent and you fill in a form, all the details are on the article on the website, you can get some support from HMRC, which could be direct engagement, could be peer group sessions, could be information. So do go and have a look at that if you're an agent. The software tool has been considerably improved. The latest version is much better. It now includes products in development as well as those that are actually fully up and running. So that's really helpful. It also now includes some assistive software tools, which I've been asking them about for months, because that was a huge problem with MTD for VAT. On launch day, there weren't any. Well, fortunately, there are now some tools that work with, for assistive software. Don't forget to apply for MTD exemptions. Don't leave it till the last minute. And do note as well that if a client or if you were exempt from MTD for VAT, that won't carry across to income tax. You have got to go and sort of reapply. So go and have a look at HMRC's guidance and make sure you get those applications in properly. We've also got professional conduct in relation to taxation. That if you're a member of ICAS or the ICAW or the CIOT, you are bound to follow the professional conduct in relation to taxation rules. It's your professional standards guidance, if you like. Now, other than the PCRT code itself, which is mandatory, the PCRT group of professional bodies also sometimes produce topical guidance, and we have in fact produced some on MTD for income tax. If you're in ICAS, it's on the ICAS PCRT page. It was issued in the summer. It's already been updated once, because basically it's got loads of frequently asked questions and the answers. So really, really helpful. Do go and have a look at that. And I say it will be updated if more information, emerges or more questions emerge. Right, this is another sneaky one that I want to draw to your attention. Because if you're a sole trader or indeed a partnership and you want to incorporate your business, so you're going to transfer the business to a company in return for shares in that company. Now, there's always been incorporation relief to remove some of the tax charges that would otherwise apply. Section 162 TCGA. Now, those of you who've been in tax for a while will be aware that you don't have to claim that at the moment. You can just do it. It's automatic. But going forward, you are going to have to claim transfers of business on and after 6th of April 26. You must claim it. It's got to go in the return for the tax year of the transfer with such information as HMRC requires. Obviously, we don't know what that will be yet. And it's really important that there are time limits for this as well. Now, why are they doing this? Well, it's so HMRC gets better data. Firstly, they can do more analysis of the relief, but secondly, for targeting their compliance resource. I'm afraid that there have been some problems with the way people have been doing it. So that's something not to miss. Don't forget, you will have to make a claim now. It's not automatic. Right, VAT. Well, it was a relatively quiet budget for VAT. She didn't significantly decrease the threshold. There was speculation that she might. She didn't increase the VAT rates. So the threshold's still 90,000. The deregistration threshold also hasn't changed, so no change there. There is a consultation to look out for in 2026 because the government would basically like people to pay earlier. So they're going to have a consultation on what they call timely payments, and they're going to look at requiring more payments to be made by direct debit. So that's both for VAT, but also for employers' pay-as-you-earn liabilities that they're paying over to HMRC. And just to mention, I was going to put a separate slide on this, but I thought we'd run out of time. There is also going to be a consultation on more timely payment for self-assessment, which is essentially more of the same. And certainly people who've got both self-assessment income and pay-as-you-earn income, they're going to be looking at getting them to pay more of their self-assessment liability in year through pay-as-you-earn. So watch out for all those consultations in 2026. Really, really big change. Now, I've put it in the VAT section, but to be honest, this is really important for everybody in a business. It's a business issue more than just a VAT issue, because e-invoicing is going to be mandatory for UK VAT registered businesses. And obviously in many businesses, it will be the VAT department, if you're big enough to have a VAT department, who will be dealing with this. So from April 2029, it's going to be mandatory to exchange invoices digitally between buyers and suppliers. There will be no manual processing. Now, notice this is business to business and business to government. This is not business to individual consumers. You're not going to get an e-invoice from your hairdresser. But it really is important for businesses. There was a joint consultation this year, and we had a really good ICAS meeting with some of our indirect taxes and OMB taxes committee members with the consultation lead. We put in a written response, and at the budget it's announced, well, it's obviously happening from April 29. It's being made mandatory because otherwise some people won't do it, and then you'll have a business that's invested in having an e-invoicing system, but some of its suppliers won't be able to accept them because they haven't. Similarly, there's going to be standards to ensure interoperability, because it's no good you investing in invoicing and sending it to your supplier and their software won't talk to yours. So they're going to have to make sure that that doesn't happen. We put lots of concerns in our response about smaller businesses and the costs, and there's a statement that that's going to be looked at and considered. It's going to be decentralised. You will not have to issue all your invoices through an HMRC central platform, which I think we're all suitably relieved about. Although that was a sort of an option, I don't think they were seriously considering a centralised model, to be absolutely honest, but they're definitely not doing it. They are, however, thinking about real-time reporting to HMRC, but that will not happen in 2029. I think they're going to let everybody get e-invoicing set up first. Now, there could be some advantages, actually, in a real-time feed once it's all set up, and they are going to continue exploring that. So we shall see on that one. Now, the next steps, they're now going to develop an implementation roadmap, and we understand that probably at the next budget, they will sort of publish that full implementation roadmap. So in the meantime, they're going to be developing it. And we'd really like your feedback. We've already been invited to take part in the discussions about that. So if you've got any immediate thoughts, do send an email to the mailbox that Katie mentioned at the beginning, tax@icas.com. Because we'd certainly be interested to know what you think. Now, I'm conscious that we are running fairly short of time, so I'm just going to put this entire slide up. I just wanted to mention this because it's good news, and we had a lot of interest in this from members who either, advise charities or are involved with charities. And at the moment, a business donating goods to charity can get VAT relief if it's donating those goods for the charity to sell on. So if say the charity's got a charity shop, it's the usual thing. But it doesn't get VAT relief if it gives goods to the charity for onward donation to the charity's users or for use in delivering the charity's services. So say you had some surplus stock of some shampoo and you gave it to a homelessness charity, you wouldn't get VAT relief. Or if you had a laptop and you gave it to a charity to use in delivering its services, you wouldn't get VAT relief. So that's a bit of a problem, and it is leading to people not making donations. So, maybe some sheets from a hotel that could have been donated to a charity end up in landfill. So basically, the government had a consultation to try and encourage donations and reduce waste, and we responded to the proposals. And I should say that there's a detailed ICAS article on the website with all the information about this. I posted it just after about the same time as the budget, because from 1st of April 2026, there will no longer be a VAT charge when businesses donate goods to charities for onward donation or for use by charities in their non-business charitable activities. And notice there are some restrictions on the value of the items. Now, we really don't have time to go into that today, but I say do go and have a look on the website, because you can get to our consultation response, and I did put a bit of the detail in the article. And the charities must be registered with HMRC for tax, and they have to be registered with the charity regulator in the relevant parts of the UK. There will be detailed guidance on this for businesses and charities, so look out for that. But I just wanted to say it because it's good news. And I know quite a lot of our members had an interest in it because I got a lot of feedback for the consultation response. Right, tax administration. Now, you might wonder why on earth I'm mentioning it with this, but there is a reason. There's a new HMRC reward scheme from 26th of November 2025. Now, there is already a sort of HMRC reward for informant scheme. There's a form that you can use to report somebody you think might be committing tax fraud, and you can make it anonymous. But to be honest, it's very little publicised. And although HMRC can give some discretionary rewards, there's no clear criteria for this, and the amounts are relatively small, because we know that because some people have put in freedom of information requests. Now, the new scheme is completely different. It's based on US and Canadian schemes. And the idea is they want people to inform on large corporates, wealthy individuals, so things where there's lots of money at stake. And you can see how much money, because informants will be eligible to receive a taxable reward of between 15 and 30% for giving information which leads directly to HMRC collecting more than 1.5 million of tax. So a lot of money. There are strict criteria and there are exclusions. So, there is some detailed guidance on the website. It's very important to go and look at that if you were contemplating this. Now, the reason I'm mentioning it is because HMRC are convinced, I was at a meeting with them the other day, they're convinced that, as happens in the US, lawyers and accountants, tax advisors are going to get approached by informants who want some help, particularly with, things like interpreting the criteria and the exclusions, because of course some informants, you might have to wonder how they've got the information and, were they involved in some way? So that's why this is here. And I'll certainly be interested to know if people do get approached by lots of would-be informants. The other reason advisors might want to know about this is because, of course, if somebody files an incorrect report, they think some fraud's going on, so they tell HMRC. HMRC may well open an inquiry into, say, the company, and the advisor to the company then will have to deal with it. So that's why I'm flagging that up. Right, I'm flagging this up because I'm hoping that some of you have already used the Tax Agent's Handbook. We did publicise it when it was launched in November 2024. It's really helpful for agents, brings together lots of things that were scattered all over the place, of interest to agents, I hasten to add. And it's just been significantly updated in November 2025. I have published an article on the website about the new improved version. Now, that's partly we in the professional bodies have given them feedback on it. They've also had feedback from agents using it. So there's some really good new sections in it, including online services for agents. So if you want to know, which am I using, my ASA or my online service account, it's all there. And resolution services for agents as well. We've got the personal tax resolution services, which is, generally thought to be doing pretty well. So do go and have a look at it if you haven't already done so, and I'd certainly be interested in your feedback. And could it be improved further? And I say all the links are in the article that I posted, so do go and have a look at that. Right, we're on the final substantive section, and I can see we are definitely running out of time. Some of you will remember, because I've talked about this before, there was a consultation in 2024 about potentially putting in place a tax regulatory framework. And we supported option 1 in that consultation, which was a requirement for tax advisors to belong to a professional body like ICAS. Now, unfortunately, the government's not going to do this. They're not going ahead. They are still going to work in partnership with the sector to raise standards, but quite how that works I don't know, because it still means that anybody can set themselves up as a tax advisor, and then if they're not members of a professional body, they're not going to have PI or CPD and so on. They do have to adhere to HMRC's standard for agents, which does overlap to some extent with PCRT. But 2 things that are going ahead. And some of you will no doubt have heard that all tax practitioners who interact with HMRC on behalf of clients are going to have to register with HMRC and meet certain minimum standards from May 2026. Now, I would have talked more about this if we had details, but we don't. All we know is it's going to happen sort of in a staggered way from May 2026 onwards. So I'm sure we will be saying more on the website when we have more information. But for now, just be aware that that's coming down the tracks. There have been some concerns about the draft legislation and about the second thing that's coming next year, which is HMRC is getting greater powers to tackle tax advisors facilitating non-compliance. Now, there have been lots of discussions with HMRC since the draft legislation was published in July. It's been significantly amended and improved after all those discussions. And maybe there's still scope to a few more tweaks, but there are still ongoing conversations. So those are 2 things to look out for, particularly the registration one, but no need to panic. And I mentioned professional conduct in relation to tax earlier. It's been updated recently, mainly to take account of the fact that ISBA had which is the international body, had launched its own tax planning related standards. Now, they were inspired by PCRT, so it was a bit ironic that it then caused some problems for some PCRT members who are both members of ICAS and the International Federation of Accountants, and therefore had to adopt ISBA. And what we don't want is people having to look at PCRT and then go and look at ISBA too. So PCRT has been updated to make sure it's at least equivalent to ISBA. The new version takes effect from 1st of January 2026. And PCRT actually goes further than ISBA in some respects because it applies to all work. Not just tax planning, it applies to all tax work. So do go and familiarise yourself with that. We did publish it on the 1st of October so people could have a look before it comes into force. And I posted an article on the website on 1st of October, which has got all the links and gives you all the background information. So do have a look at that. Right. Now, these are my standard 2 final slides. Some of you will doubtless have seen these before. So all this is to say is that we obviously report anything you report to us, problems with HMRC services, any suggestions on policy and technical issues. And funnily enough, recently we did get a lot of suggestions on simplification options, which we have put to HMRC. So we're waiting with interest to see if any of them emerge on that TUSAR day early in 2026. We also give input through the Charter Stakeholder Group. We have meetings with HMRC, with ministers, we do representations, we respond to consultations and so on. But all of this, we obviously need your input. So do let us know what you think. But, you know, whenever I post an article on the website, there's usually something at the end that says, let us know what you think. Tell us if you're experiencing big problems with some part of HMRC services. And there's the tax mailbox address, already been mentioned. Also, I mentioned committees. We do a lot of work on responding to consultations with our committees. They cover the main areas of tax. So I look after private client and indirect taxes. We also have one international and large business taxes. Katie looks after devolved taxes. And we have an owner managed business taxes committee too. So if you're interested in joining, the adverts go up throughout periodically in the year when we have a recruitment window. So do look out for that. And if you've got time, think about applying to join one of the committees. Okay, that's everything that I had time to cover. Sorry we didn't manage to cram everything in, but I hope you found it useful. Thank you very much for listening, and I'll probably see you for the spring update next year. And now I'm going to hand you back to Katie to wrap up.
Thank you, Susan. Well, that's us now out of time. It would be great if you could leave us a rating for today's webinar. There should be a question poll appearing on your screens very shortly. There it is. I could see it come up. Thank you to our speaker, Susan, for joining us this afternoon. That was a lot of information to get through, and we thank Susan for sharing her insight and knowledge with us. If you need any further guidance on what we've discussed here today or any other matters, it can be found on the links on your screen. We also have some events coming up, and there will, as Susan mentioned, there will be a webinar in January with myself to cover the Scottish budget and devolved taxes if any of you are interested in that. And it only leaves me to thank Susan once again, and of course you, the audience, for joining the webinar today. Many thanks to you all, and I hope it has been helpful.